We are here on another Friday afternoon, episode 5 of What's the Mortgage Deal? I'm your host, Josh Thielen. We are discussing the 4 major loan programs going back to last week. There's basically 4 major programs that most home buyers are going to fall into these categories. Conventional FHA, and today here on this Friday afternoon, we're going to talk about everyone's favorite type of financing, and that's 100% financing, zero money down loans. Those 2 programs that we have at our fingertips are the USDA loan, U.S. Department of Agriculture, and the Veterans Administration loan, so VA loans. 2 great programs. So let's just get right into it and start talking about some of the eligibility requirements and some of the limitations of the program. So USDA, 100% financing. Again, zero money out of your pocket. We're going to talk about real quickly how we can actually include the fees and closing costs of these types of loans into the actual loan amount as well. So the borrower has to come to the table with very, very little money out of their pocket. We're talking inspection fees and appraisal fees for the most part, maybe a credit report, depending on your lender. Okay, loan amount restriction. There is none. For USDA, there is no loan amount restriction. The restrictions on USDA are going to come when we discuss income limitations really quickly, okay? So why don't we jump to VA as well? 100% financing. We'll kind of shoot down the categories. Loan limit for a veteran administration, okay? That is going to be $453,100 on a single family, up to on a 4 family, and you could do 100% financing from a 1 to 4 unit with a VA loan. USDA is going to be a single family residence only. Okay, this goes up to, I think, 871.5. I know, strange numbers, but that's on a 4 unit, and you can obviously, there's limitations on 2 and 3 as well. So again, you can look those up, or you can reach out to me and I can get you those loan limits. FICO requirements for the 2 programs. They both start at 620 for us. For the VA, there is no set FICO score requirements set by the Veteran Administration. It's going to be lender specific based on lender overlays. That's lender specific. Really, both these programs are going to start with your optimal pricing at 640. So I always work with my borrowers to try to get them to a 640 mid FICO score. So that's your TransUnion, Equifax, and Experian score. Take all 3 of them. They go off the middle score of either borrower. So in the lower one, if you have 2 borrowers, they're going to go off the lower of the middle FICOs. Okay, debt to income ratios, very important when it comes to these 2 loan programs. Because they are 100% financing, the lenders and the government wanted to make sure that the homeowners didn't get into trouble. And there weren't a lot of foreclosures and people defaulting on these loans. And again, if there was a default, the United States government, Ginnie Mae, which runs these 2 programs, would step in and pay the lender back for the defaulted funds. But debt to income ratios are going to be a little bit lower than they would be for an FHA or conventional loan. And let's talk about front end and back end. So the VA loan has a 41% debt to income ratio limit. Can you go slightly over that? Yes, you can. You better have some compensating factors, like good FICO score, reserves, long time in your job, things of that nature. So again, the USDA has a 41% back end. There is no front end debt to income ratio maximum. So, and let me explain back end, front end very quickly. Front end debt to income ratio, USDA 29%. That takes into account your gross income divided by your monthly bills. So, and that's just your mortgage related costs alone. So just your principal, interest, taxes and insurance, and your MI. Take your debt that's reporting on your credit report. The front end is just your principal, interest, tax and insurance divided by your gross income monthly. That's going to give you your front end. The back end takes into consideration all the other debt reporting on your credit report. Remember, it's just going to be revolving installment debt. Your utilities, your cell phone, your health insurance, your life insurance, those bills do not account for your overall debt to income ratio when it comes to lending and loan programs. So it's just going to be the revolving and installment debt that's reporting on your credit, as well as any alimony or child support bills. Okay, so 29% for your PITI on an USDA loan, and 41% when you add in other your debt. VA, very similar. There's just zero front end. They don't count the front end. They just look at the overall debt to income ratio. And again, compensating factors will allow those debt to income ratios to go slightly higher. Okay, PMI. USDA is going to have a 0.45 factor. Okay, FHA at a 0.85 factor. So you take that factor and you multiply it by the $200,000 loan amount that we talked about last week, and you take 0.0045, you multiply it by 200,000, that is $900 divided by 12, and you're going to be at, I think that's like $70 or $75 a month would be your MI payment. Not bad at all, very affordable. It's going to be half of FHA and even lower than half, even more than half on your conventional loans, especially with little money down. VA, no MI. No MI on VAs. Our military, they say, no mortgage insurance, you're good to go. Zero MI. Upfront funding fee, okay, on each of these loans, because there are defaults and there are risks and we are doing 100% financing, there are what's called upfront funding fees on these programs. These are multiples, again, of the overall loan amount, and they're added to the back end of the loan. So it adds to your overall loan amount. So the USDA upfront funding fee is 1%. So on a $200,000 loan, that's $2,000. So your loan amount would be $202,000. For VA, it is 2.15. So if you multiply 0.0215 by 200,000, that's $4,300. So your loan amount would be $204,300. So I hope that makes sense. If you're 10% disabled or greater for the VA, there is zero upfront funding fee. Okay? Important little side feature. All right, great. So we've talked about the 6 major categories of the 2 loan programs. Seller concessions. USDA allows for 6% seller concessions. So you can take $12,000 and use that to pay your upfront funding fee and any of the costs of the loan. VA, 4% of the overall loan amount can be, now again, the appraisal has to come in that much higher than the actual sales price, but if it does, you're allowed to finance those closing costs paid by the seller technically because we're building it into the loan, but 6% on USDA, 4% on VA. Great opportunities to even allow less money out of our clients' pockets at the table. Income limitations. This is big for USDA. VA, zero income limitations. You can make as much money as you want. You can qualify for a VA. USDA, 1 to 4 household, 1 to 4 people in the household. It is going to be $78,000. That is the max amount that household can use as gross income to qualify for a USDA loan. If you make $79,000, you're out. $78,005, you do not qualify for 100% USDA financing. Household with 5 to 8 people, you can have $103,200. That can be your combined household income. So we've covered a lot of information here today. Hopefully this enlightens folks that are checking out my video on 100% financing options, what that incorporates, debt to income ratios, PMI, upfront funding fees, loan limits. Again, some really good information shared here today. I hope that you guys took some things away from it, and have a grateful weekend. And thanks for following me, and we'll check you next week. Thank you. So thank you very much for listening in today. We appreciate any of your comments and your following of What's the Mortgage Deal, and we'll catch you next week. Peace.